Hello and welcome to Money Talks. I'm Peter Switzer, and tonight's show we ponder, in light of the Royal Commission, should we be investing in companies that actually have a good culture? To that end, Bell Direct's Julia Lee gives us her top pick of the week, and we talk to John Tringali from WCM Global Quality Fund. These guys trawl through the top businesses of the world looking for companies where the exceptional culture has resulted in this fund manager being a global outperformer. But first we look at a listed property company which so far has not had a culture problem. Let's catch up with its CEO, John McBain. John, thanks for coming on the program.
Good to be here.
Now, you and I've known you for ages, and I've never ever asked you about your culture. I always presumed it's a pretty good culture from what I've seen there. But has it been an important issue for you when you constructed this company?
Oh, vital. You know, our company's a little bit different. And you look at the two promoters who built the company are still there after over 20 years. So when we employ new staff, obviously their qualifications and basic credentials must fit the role. Yeah. But that's not enough. I personally interview every single person who comes into the company at every level. And one of the things we're interested in is people who are interested in being of service to our investors. You know, there is probably nothing more important in the financial services industry. And I think if we continue to keep sight of that, find people who are interested in the betterment of our clients, that's a crucial part of culture, that if we embed that right throughout our organisation, we'll go a lot further. And
you do come from New Zealand, as I like to always remind.
We have culture there.
Yeah, no, but it is traditionally a more old-fashioned culture, New Zealand. Do you think you've carried the old-fashioned culture, even though you're a modern business, but the old-fashioned culture that you were brought up in?
Yeah, I do, but look, we've had a fantastic life here in Australia, and I think there's plenty of great culture here. I think they're two very similar cultures.
Great answer, mate. Now, what is Centuria? People have heard the name, you've often performed very well, but a lot of people wouldn't know specifically what Centuria is.
Sure. So in my position, I'm the Group Chief Executive and I run Centuria Capital. That's the parent company.
That's the listed vehicle?
It's listed, C&I, and what under the parent company, we have various subsidiary companies or companies that we manage. Mostly it's real estate. We manage two listed real estate funds, and one's industrial, one's commercial. They're code CIP and CMA. They're relatively large in their own right, and they have separate ASX 300 listings. They have about 2.6 billion managed between them. So they're open all the time to invest in commercial and industrial property that's listed. We also have a series of unlisted funds. Now, they're not always open. Currently, there are 15 of those, and they're about 2.2 billion.
Now, when you say open, people might not understand, but effectively, you go around looking around Australia for great buildings, and effectively you take possession of them, you upgrade them, and the people who put their money in sort of, what's the smallest amount they could put in?
Oh, 50,000.
50,000. They then get a rental income over the period of time when you hold it, and eventually you sell it.
Correct. And we're trying to provide smooth growing distributions that come from the renter, obviously. And then hopefully we always try to buy an asset that we think we can improve, whether someone has neglected it, whether we think the rents are very low and could be increased, or we think there are various demographic factors. You know, and we've had some good examples. We've made some great gains for our investors. Yeah.
Now, a lot of people think, hang on, but I keep seeing headlines that the property market's in trouble. Are you threatened by the property market headlines?
Well, at the moment in Australia, what we're seeing is a lot of talk about the residential property markets, which is quite typically the first thing people talk about. And I do think, and perhaps, you know, we don't play in that market very rarely.
It's been unbelievably hot.
Look, it has been hot, and we can conjecture all we like. I know there's been a little bit of price tension on some of the apartment markets. Our fear is really we wouldn't like any contagion in the commercial and industrial markets, but at the moment they're particularly strong.
Sydney, the commercial and industrial market, that's where you play. The outlook is good, not
very good, very good. And in fact, the latest office vacancy statistics for Melbourne and Sydney are one of the lowest for 7 or 8 years. So which supports more growth.
Yeah. And so ultimately, your argument would be the stronger the Aussie economy, the better it is. But Sydney and Melbourne, the vacancy rates are quite low for
3.2 and I think 3.6%, and that's extremely low.
Okay. Yep. You were recently reported. Tell us about how the company reported.
We're very happy with our 6-month interim report. We just released a 4.25 dividend. Yeah. So during the 6-month period, profits were up. But we also increased our assets under management just 14.3%. So with property funds managed at our parent company level, it's very important that we can show the market we're growing. So, we've grown our share price quite a lot over the past,
Well, I looked at it, okay, on 5 years, you're up about 65%.
That would be right. Yeah. Yep. But also a growing dividend during that period.
Okay, so if people want to know approximately what's the dividend yield on an annual basis, what would you say?
At the moment, we're forecasting a yield of a distribution of 9.25 cents, which incidentally would be up 12.7% from the previous period, so quite a healthy increase, and I think that would show on the current share price over 6%.
Okay, so what's going to be the game changer? What's going to actually reinforce the progress you've made? Because you'd like to become a top ASX 300 company, and you're kind of on the way to do it, but you need to go to the next level, don't you?
Correct, we do. Both our listed real estate vehicles are quite large. They have $1 billion and $1.4 billion between them. So they are already on the ASX 300. Now we've got to move the parent company there. So I think as we get larger, I think we'll get greater recognition. When we look at our earnings multiples, our very steady rising distribution, our ability to really grow our assets under management and grow our platform, we don't think the market really knows who we are yet. And I think that's just a function of size, Peter. Yeah. We must get bigger.
Without doubt. Well, that's a very good summary of Centuria, mate. Thanks for coming on the program.
Thanks a lot.
That's John McBain, who's the CEO of Centuria, of course. So coming up after the break, we'll talk to Builder X Julia Lee, who's gone hunting for companies that have the right culture. Welcome back. Each week, Julia Lee goes looking for hot stocks, and this week she shines the spotlight on companies with a great culture, including environmental, social and good governance. Julia, thanks for joining us.
Pleasure, Pete.
No, I've never really talked to you about selecting companies on the basis of culture, but has there been something that you've thought about in the many reasons that you select companies?
Well, Pete, I always like to find that edge when it comes to investing in the market. And traditionally, ESG has been all about risk.
ESG, you've got normal people watching this program.
Environmental, social and good governance has been all about reducing the risks and managing the risks and avoiding those big catastrophes like we saw out of the Royal Commission.
And Vale and BHP, with tailings dams collapsing, all those things.
But there's an increasing body of evidence that it's actually good for performance as well, and I guess that's the exciting part when you're looking at the market from these type of filters, and it's become part of the investment process, not only to manage risk but also to enhance performance.
Okay, so why don't we start with the companies that you like and tell us what you think culturally is so important about them?
Well, there's a number of different levers that you can use in this area. One of them, I guess, is human capital management. I mean, when we think about human capital and places where people want to work and where there's a low turnover of staff, there's increased productivity. And look, that's great news in terms of profit performance and increasing the return on invested capital as well. So human capital management can also be tracked.
But it's funny, you and I remember Google when they first came on the scene. They had table tennis tables and bean bags and all those sort of things.
Kitchens full of food so you don't have to leave the office. But people actually enjoy being there as well, so productivity increases. And actually there has been a body of research on human capital management on markets throughout the globe showing the link between human capital management
Only an economist would call people looking after people as human capital management. Okay, let's go to the companies that you like as a consequence.
Oh, well, One other thing I want to touch on is what we call insider buying and selling on the market. Now, this is not insider trading. It's more inside management and the board buying and selling shares, which often can be an indication of good or bad things to come. One person buying or selling is seen as a small positive or a negative, but when you see multiple, that can be a sign that there's big things to come. I mean, I remember in 2016, we saw Bellamy's CEO as well as chairman selling out of stocks, and that year in December, they reported a loss of almost $4 million, I think. So I've been looking at the buying and selling ahead of reporting season, and I've noticed that some of the gold CEOs have been selling. So we've seen Jack Klein from Evolution selling $9.5 million worth of shares, and also Northern Star CEO selling around about $1 million worth of share. And in the computer registry or the share registry business, we've seen Computershare, Christopher Morris selling $8.1 million worth of shares.
No buyers.
Link has been buying $1 million. Yes, $1 million worth of shares. So Link is my buyer today. Look, the growth story, I think, still is intact, and I think in the second half of the year we'll see a recovery there. But the other one where we've seen... I've got to say, I
know John McMurtry, he's a very good man, so he would breed a very good culture, but go on.
But if I can mention one more, Nine's another one where we've seen Bruce Gordon buying quite aggressively over the last few months, from 8.9% to 15.3%, which is a pretty big move. And look, Nine, Domain, Stan have been outperforming, and I think in the second half we'll continue. There's an election too.
He's got a very good reputation as a leader as well, and that's probably has an impact on the culture.
And election spending.
One last one. IAG, did you have
insurance. It's Australia Group's an interesting one because they've reduced voluntary turnover of staff quite significantly over the last couple of years, but there's also things to try and improve not only the culture within the business, but with customers as well. So when there's a big scale disaster, they actually send text messages reminding people to lodge their claims early. So when we saw the hailstones in New South Wales at the end of last year, and that reduces fraudulent claims. It also locks in labour because when there's a huge disaster, labour costs absolutely soar. And you liked IAG a few weeks ago, didn't you? Yes, I still like it. And you like Bluescope as well, and that's done very well. Yeah, Bluescope. You're on a bit of a run, Julia. Thanks, Pete. That's Julia Lee from Bell Direct, and she'll be back next week with another series of hot stocks. Coming up after the break, we'll be talking to John Trigali, who is a portfolio manager from WCMQ in the USA. They're listed on the Australian stock market, and they select companies purely based on culture. Welcome back to Switzer. Now, my next guest is John Trigali. He comes from a company called WCM Quality Global Fund. Now, these guys are based in Laguna Beach in California, and they are regarded as some of the great fund managers of the world. And they have a listed vehicle on the Australian stock market called WCMQ, which I have a bit of a relationship with, and I'm really happy to because of their reputation for selecting companies that have two things: a moat around them, and John will explain what he means by that, but also that moat is often created by the fact that the company has a great culture. And I think a lot of people following the Royal Commission believes this might be the way to go when it comes to selecting companies. John, thanks for coming on the program.
My pleasure. Thanks for having me, Peter.
So tell us about the moat, first of all.
So the basic idea with a moat, and of course it was a term popularized by Warren Buffett, as really the sum of the competitive advantages of a business. It could be things like the brand, intellectual property, networking effects, things that protect it from competition, enable it to continue to earn profits and high rates of return. Yep. And as you might have heard, Buffett has really popularized this idea going back 40 years that the way to invest is to try and buy high quality, wide moat businesses or businesses with large competitive advantages. And of course, you're trying to buy these businesses cheaply or at a discount to their intrinsic value. Now, that's really the conventional methodology, and our approach is a bit different. When he popularized that many years ago, there probably was a lot of low-hanging fruit to be had by just looking for a wide moat and looking for it cheaply. But Coca-Cola, American Express, McDonald's. See's Candy. No, pretty easy. Yeah. Pretty easy. But in today's world, you have so many investors around the world, a lot of smart people that are looking for those exact same thing of a high-quality business, a wide moat, moat, and they're looking to buy it at a discount. And so we're of the view that if everyone's doing the same thing, there probably aren't a whole lot of inefficiencies to exploit by just focusing on the size of the moat.
Yeah.
And so how we do things a bit differently is we spend a lot of our time, as you said, on culture and also assessing the competitive advantage of a business, but understanding how is it changing. You know, any business we look at out there, its competitive advantage is not static. It's ebbing and flowing. It's getting stronger or weaker vis-a-vis its peers. And we're convinced what really drives stock returns is getting in front of expanding moats and conversely avoiding ones that are contracting and coming in. That's where you can.
Yeah, so a company that had fantastic competitive advantages is then losing it. And I guess Walmart was in a situation like that when Amazon came on the scene.
Yep.
The moat actually contracts.
Exactly. They didn't adapt. They didn't get online fast enough, and the culture, you know, had departed from how great it once was at Walmart. And you hear stories about how they squeeze suppliers.
When did you guys have the eureka moment that culture was really important for growing the moat?
Yeah, it really comes from our firm's own history. We had the first 20 years of the firm from 1976 until the late 90s when the current management team bought it out. Back in those days, WCM was run by one individual. He made all the decisions. He made all the money. He had all the power. And so, as you might imagine, he couldn't keep talent. Yeah. You know, you can attract talent in this business. It can be lucrative. It's a lot of fun, but they'd walk right out the back door. And the firm never really had much success. When the current team came in, they said, we're going to basically go 180 degrees the other way. We're going to share the wealth. We're going to give people a voice, talented people. We're going to include them in the economics of the business, and it's worked.
But a lot of those people were actually working for the original founder.
Correct. So through that hardship, they said, you know what, if we do quite a bit different than this, we'll probably be okay.
Okay, now we've got your performance. We can put that chart up in a moment. But you have done very, very well over at least a 10 or 12-year period. You can see there, 1 year, 3 years. You know, the tricky 3 months before Christmas, we all had problems with that period of time. But as you can see, you've done very, very well. You're in the green, and the MSCI is in the pink. What do you think explains your consistent good performance? Because everyone makes mistakes.
Yep.
Do you quickly learn from mistakes and you're prepared to take your medicine really quickly, or what?
Absolutely, and I think that's a big part of the culture on the investment team at WCM is continuous learning, constant improvement. We have to be always trying to get better as investors. It's a very, very competitive business. You have a lot of really smart people out there, and if you're not constantly learning from mistakes, you're not going to get better. And so one of the things that's really encouraged is to be very open and candid when we make stock mistakes. Don't sweep it under the rug, like maybe you'd be tempted to at a lot of firms, but at our shop, we want to bring those into the open. It's encouraged to share those learnings with the team.
Californians without an ego, that's amazing. You guys are terrific. Now tell us about a company you've specifically bought because you think their culture is fantastic.
Yeah. You know, one that comes to mind that we just bought last year is Shopify out of Canada. Wonderful business. It reminds us a lot of Amazon 15 years ago in terms of the competitive position, the culture, very entrepreneurial. It's kind of the place to work in Canada among engineering talent. They're attracting all the stars. And also the runway. You know, they're about 4 or 5% penetrated in North America of this market of helping businesses go direct to consumer, sell their products to consumers directly as an alternative to maybe Amazon or Alibaba. So there's a lot of runway for growth, and the culture is really driving that. They have an obsession with the merchants who are their customers, who are maybe left out in the Amazon model a bit, and they're serving those and helping them.
And is that your argument that as Amazon gets bigger and bigger, it provides opportunities for smaller companies to exploit where they're not strong?
Well, it does, because and Amazon's had a ton of success, and their culture, they've been all about the end consumer. How can we add the most value for them? How can we get them the lowest prices, faster shipping times, more things bundled in their Prime membership? So that's worked great, but when you think about who's left out in that equation, there's a vacuum in the marketplace where the merchant is an afterthought. And so if I'm a merchant and I sell through Amazon, they control how my product comes up in a search. Yep. They control the data, who's buying what. I'd love to have that as a merchant. And most importantly, they're taking a huge commission. So the take rate, if I sell a product on Amazon or Alibaba, they're taking 20, 25, 30%. Right. Shopify is taking 1.5%.
Okay. Have you sold any stocks because you thought they were having a cultural problem?
You know, another one just last year that we actually sold in order to buy Shopify was Facebook. We had a nice run with Facebook for many years, and we sold it in May of 2018. The culture was part of it. I think going back to the idea of the competitive advantage, engagement on the core Facebook platform has had some struggles. There have been some strategic missteps, but that has also exposed, I think, a much more fragile culture than was thought before. We've seen some lack of some turmoil at the top, and then we've also seen talent fleeing Facebook and going to other Silicon Valley firms. Not a good recipe in that environment.
Okay, so how is the portfolio positioned today, and where you're seeing opportunity?
Yeah, so we have these perennial overweights into the traditional growth parts of the market. So we have a lot of investments in technology, in healthcare, and in consumer. We think that's where most of the spending is going to be going forward. And so there's a natural tailwind behind this portfolio, but specifically within healthcare, we're seeing a lot of exciting opportunity. There's really two big ideas that are driving, we think, a couple decades of structural growth in healthcare. You have aging populations around the globe, and you have massive increases in government spend and just general spend on healthcare, particularly in the emerging world. And so as we think about who's going to benefit from that trend, we don't think it's necessarily going to be the big pharma companies that have a $50,000 or $60,000 cancer drug. We'd rather bet on the companies that are going to make the basic tools, supplies, devices that are going to be needed at all outpatient facilities and hospitals around the globe.
Compulsory products.
Compulsory products, exactly, that are essential, lower cost. We call them picks and shovels plays to participate in the growth of the sector, but take on quite a bit less risk.
Okay. So if you had to reflect upon, one of the best selections that you've made, and you've made a lot of money out of it based on culture.
Yeah.
It might be a hard question for you, but...
No, there's a lot. I mean, Tencent pops into my head.
Yeah, so Tencent has a good culture.
It really does, and the Tencent culture is all about the user experience. In fact, their developers, they're not compensated on revenue, products they come up with and invent. The revenue is not important. What matters is user satisfaction, how high their scores are. And so that has built this environment where the behaviors that are really valued and what drives them is ultimately adding value for their users. And that's why we think they've become the dominant player in mobile with WeChat, and we're seeing the same thing in payments.
Okay. Now, you guys did reasonably well during the GFC. And whenever I've asked your colleagues in the past who've come to Australia, I've asked them about, what's your outlook for the US economy and the market, and they say, well, we don't particularly care about that because we care about companies. Are your companies, because of the way you select them, do you think that they're reasonably recession-proof?
Parts of them are. So we try and have a balanced approach in the portfolio to different types of businesses, some that are going to be higher growth, a little bit more sensitivity to the macro, and some that are going to be defensive stalwarts that are going to be your anchors to the wind. So having that right balance is important. So in a market like 2017, which was more of a bull market, you had growth was rewarded. You needed some of those high growth Amazons, Tencents to keep you in the game. But in a period like the fourth quarter of last year where we saw those negative returns, you want some names that are going to attract the investors who are, where there's a safe haven, a name like Pernod Ricard, where their spirit sales are going to actually increase in a downturn. Yeah, without a doubt. John, thanks for coming on the program. My pleasure. Thank you. That's John Tringali, who's a portfolio manager with WCMQ, which is listed on the Aussie stock market. Thanks for joining us. If you want my daily market and economic insights, go to switzer.com.au. And for any investment ideas, have a look at the Switzer Report. That's it for Money Talks. I'm Peter Switzer. I'll see you next week.